Okay, good morning to everyone. Can you see me and hear me well? Okay, thank you. So we wait for another minute or two for other students to join, and then we start. Okay, let's start. So as I mentioned last time, today we're going to look at capital requirements of market risk, which is a bit following the logic that we'll follow for other kinds of risk as well. So we first look at the different methodologies to measure the individual kind of risk, and then we're going to look at how the regulation, more specifically how the Basel Committee first, and then the other regulators have addressed this kind of risk in terms of capital requirements. Remember when we originally discussed interest rate risk for the banking book, we said that there is no explicit capital requirement for interest rate risk, but rather there is a monitoring system which is based on a system of time buckets, maturity buckets, where banks have to include their positions which are sensitive to interest rate changes. So we discussed in the past few sessions the different approaches to measure market risk, so the different approaches to measure value at risk and finally expected shortfall. What we're going to do today is take a look at how the regulators have actually dealt with market risks. And we'll see that there's been quite an evolution in terms of the system to measure market risk and capital requirements by the regulators. And it's a process which is in some way still ongoing, okay? So more specifically, we're going to first look at the standard approach and internal model approach that have been originally introduced back in the late 90s. And then we'll see the main changes that have been introduced after the great financial crisis. And finally, what's going on recently, which is also called the fundamental review of the trading book, where a number of innovations are going to be introduced gradually over the next few years, okay? Now, as you know, we mentioned already, the Basel Committee is a kind of supervisor of the supervisors. So it's a kind of common forum where all the banking regulators regularly meet and actually discuss and make proposals concerning common ways to regulate, especially solvency and liquidity of banks, okay? Now, in terms of what has been the evolution, just a very simple slides that give you an idea of what has happened in the last, I would say, 30 years. So capital requirements were first introduced in 1988 by the Basel Committee, and they were actually only concerning credit risk. Okay, the credit risk capital requirements have then been significantly changed, first with Basel II in 2004, and then more recently with Basel III and Basel IV. And we'll talk about that in the second part of the course. Market risks capital requirements have been introduced originally in 1996. Then they have been changed with Basel II in 2004. And then more recently with Basel IV, they are in the process of being significantly changed. And finally, there are also capital requirements for operational risks that have been originally introduced with Basel II in 2004 and have been revised after the great financial crisis with Basel III. Okay, so before we move to understand how capital requirements for market risk have been designed, let me give you a very brief introduction of the system of capital requirements. I mean, I'm saying a few things that most of you probably already know, but I think it's important to have this background knowledge, which is well understood by everyone. Now, as I mentioned, the capital requirements for banks were first introduced back in 1988. At that time, the objectives were twofold. First, to improve the solvency of internationally active banks, because in some way simple capital ratios had been declining over time for quite some time, for quite some decades, I would say. And therefore, there was the desire to reverse this trend and try to strengthen the solvency of banks that were operating at the international level. Keep in mind that the Basel Committee only deals with banks that are internationally active, okay? And it actually deals formally with G10 countries, so the largest countries in the world. And the second objective was the one of leveling the playing field, in some way trying to enhance the fairness of competition. At that time, in the second part of the 80s, there were significant concerns, and I would say also complaints, by the United States, because their banks were losing competitiveness, especially with respect to the banks of another country, which were becoming more and more powerful all over the world in the late 80s. What was this other country? Who knows? Which country had banks that in the second part of the 80s, in the 80s, were actually gaining market share with respect to the US banks at the international level? Anyone knows? Anyone wants to guess what country was becoming more and more powerful at that time at the international level in banking? Let's see what's the guess. Yes, that's correct. It was Japan, indeed. So the US, so the major Japanese banks, if you look at for example, the international rankings, largest banks in the world, at the end of the 80s, at that time, the Japanese, in the first 10 positions, 9 out of 10 were Japanese banks, okay? And the US were arguing that this was because in Japan, they had no capital requirements, no capital regulation. And therefore, Japanese banks could actually work with a very high leverage. While US banks, just as, for example, UK banks, were subject to capital constraint. There was a minimum capital requirement, okay? So basically, they managed to persuade the Basel Committee to put forward a proposal for a common system of capital requirements that was designed, as you probably know, as a simple ratio between capital. What you see in the numerator here is regulatory capital on the numerator, and on the denominator we have the risk-weighted assets of each bank. So basically, it's the sum of each individual asset, I, each one of them multiplied by a risk weight, okay? Now, this ratio, which is a risk-weighted asset ratio, is a proposal that was put forward in 1988, agreed by the Basel Committee, and became effective in most countries of the world by 1992, okay? And they said it should be at least 8%. Why 8%? Well, 8% was more or less the level of the banks that were, let's say, well capitalized at that time. So it was in some way putting an effort, imposing an effort by all major international banks to strengthen their solvency and increase their capital ratio. Now, the important point to understand is that at that time, if we want to understand how that ratio worked, we need to understand what was at the numerator and what was the denominator. The numerator was regulatory capital, and regulatory capital at that time had two components. The so-called Tier 1 capital, which was what we generally understand to be equity capital. So like the equity of any other kind of firm, of company. So common equity, disclosed reserves, non-cumulative preference shares, and so on, okay? What we generally consider to be equity in any company. However, it also included Tier 2 capital, even if with a constraint, i.e. not more than 50% of the total numerator could be represented by Tier 2 capital. And Tier 2 capital included subordinated debt and undisclosed reserves, hybrid debt. Now, first of all, let me ask you, do you all know what subordinated debt is? You all know that? Okay, let me give you a very simple idea. Now, when we talk about subordinated debt, what we mean is, as probably some of you know, we mean what is in between debt and equity. So let's say this is the balance sheet of any company. You have the assets on the left side, you have liabilities, debt here, and equity here, okay? So when we talk about subordinated debt, we talk about something that stands in between debt and equity. So that means that, first of all, it's debt. So it pays an interest rate, not dividends. It pays interest, okay? Second, it's subordinated to senior debt, okay? Which means basically that if there is a problem, if there is a default of the bank, these people have a riskier position than senior debt holders. However, they are senior with respect to equity holders, okay? So basically, if there is a default, these guys get reimbursed first, then the subordinated debt holders, then the shareholders, okay? Because it's debt, but it's riskier than senior debt, it pays an interest rate which is higher than the interest rate on the senior debt, okay? Now, why do we allow subordinated debt to be part of regulatory capital? Who tells me this? Why do we allow subordinated debt to be part of regulatory capital? Anyone wants to try? Who do we want to protect with capital regulation? Why do we have capital regulation in banking? Who do we want to protect? Anyone? Come on. Now, when we look at a bank balance sheet, if we want to impose capital requirements like here, the reason we do that is because basically we want to protect the depositors, because people who deposit money in a bank typically are doing that based on trust. I mean, they don't look at the credit worthiness of the bank, okay? So we want to protect depositors, and depositors typically are senior debt holders, okay? Therefore, if we allow banks to use as part of their capital subordinated debt, then this is a way, an indirect way to protect depositors, because we are actually imposing the bank to hold a kind of liability which is junior with respect to deposit, okay? And therefore, this is a way to protect depositor, just as equity is, okay? So subordinated debt, like other kind of hybrid instruments, which stands between equity and debt, were allowed to be included in Tier 2 capital, okay? There were also some rules like saying that you had to deduct goodwill and intangibles from Tier 1, and also you have to deduct from capital the investments in other financial institutions. This is just to avoid kind of double leverage phenomena. So say, for example, Bank A and Bank B, they both issue capital and they both buy the capital increase of the other bank. It's just an issue of paper. There's no fresh money in the banking system, and therefore we want to, neutralize this kind of potential issues. Now, if we want to understand how this works, this ratio, not only we have to understand the numerator, but also the denominator. At the denominator, in the 1988 Accord, things were very simple. There were 4 different kind of risk weights. So each individual asset here at the denominator must be weighted, be multiplied by a simple system of risk weights. And risk weights could be 0%, 20%, 50%, or 100%. And basically, the assets that are considered to be very, very low risk, like cash or government bonds issued by OECD countries, would get a weight of 0. Then loans to other banks, for example, would get a risk weight of 20%. So, for example, if you give a loan to another bank of 100 euro, how much capital do you need to hold? You give a loan to another bank of 100 euro, the risk weight is 20%. So how much capital do you need to hold? Come on, at least one. A loan of 100 euro to another bank has a weight of 20%. How much capital do you need? You're still sleeping this morning. So it would be 100 at the denominator, multiplied by 20% becomes 20. You need 8% of 20, so 1.6, okay? Mortgage loans, because they're guaranteed with the real estate, they get 50% weight. So if you lend 100 euro for a real estate mortgage, you would need 4 of capital. While if you lend money to a normal corporate, a private company, for 100 euro of loan, you would need 8 of capital, okay? Now, what were the problems of the capital accord of 1988? The main problem that we are concerned today is that it only looked at credit risk, okay? And then, of course, every loan to a private company had the same risk weight. There was no consideration for diversification, for maturity, for guarantees and hedging policies. But what we are looking at today is that if you look at these risk weights, now these risk weights, the underlying idea is the more risk you take as a bank, the more capital you need. But in this kind of logic, the only risk we are looking at with this kind of risk weighting system is credit risk, okay? Because the underlying assumption is that if you lend money to the private sector, you have higher credit risk than what you get if you lend money to another bank, or if you lend money through a mortgage which is guaranteed by real estate, okay? But there is no consideration of interest rate risk, there is no consideration of market risk, okay? And what we are focused on today is market risks, okay? So what happened with reference to market risks? Now, in 1993, the Basel Committee actually proposed to extend the minimum capital requirements also to market risks, okay? And it put forward a proposal with the standard approach that was, we'll take a look at it in a minute, that was rather complex and sophisticated, detailed. And the banking industry all over the world responded by saying, well, we do not agree with this system. We believe that we have already developed our own models to measure market risks. And at that time, we were talking about value at risk models. And so the banking industry said, you should not impose us how much capital we need for market risks. We have our own models. These are very good models. And we know how much capital we need based on our value at risk models. So you should allow us to use our own models to set the amount of capital we need. Now, at that time, the Basel Committee was chaired by an Italian, Tommaso Padoa-Schioppa, and he basically said, okay, let's see how your models work. And what they did, they took say a portfolio with some 300 different positions, let's say in equity, in derivatives, in interest rates, in commodities, and so on. And they asked the 20 different banks how much capital they thought they needed for this portfolio, the same portfolio to all the 20 banks. And of course, the banks came up with different results. Different results because, you know, some banks were using, say, parametric approach, others were using historical simulations, and so on, right? Maybe different confidence level, different time horizons, all the parameters that we saw so far, okay? And so the committee then in 1996 said, okay, I'm going to allow you to use your own models. It was a kind of revolution in banking regulation, because if you think about it, it's a bit like saying, you know, you can decide on your own how much tax you have to pay this year, okay? So it was quite a significant innovation, because the Basel Committee said, okay, I will allow you to use your own model, to use your own value at risk model, to compute how much capital you need on your own. However, you will need to respect a number of conditions, okay? Now let's look at the way this capital requirement then worked. Now, first of all, the capital requirement for market risks concerns both the trading book for positions in debt securities and equity securities, both for specific risk and generic risk. And this is only related to the trading. Plus, there is a requirement for foreign exchange risk for foreign currency positions, and this is actually related to the entire bank balance sheet, not only the trading. Okay. Now, if you look at the trading book, for example, equity positions, you know what is specific risk and generic risk. Basically, generic risk is systematic risk, i.e. the risk that the entire market goes down, while specific risk is the risk the individual security actually loses value, okay? In the case of debt securities, so in the fixed income world, specific risk and generic risk. So generic risk for debt securities, what is generic risk for debt securities? Who tells me? What is generic risk for debt securities? Well, come on, what is the factor that makes all debt securities lose value at the same time? It's interest rate risk, right? When interest rates go up, exactly. When interest rates go up, of course, all debt securities, all bonds lose value. And what is specific risk for debt securities? If you have a bond, what is the specific risk? The risk that the individual bond price goes down, that is typically related to what? To credit risk, right? I mean, if you have a downgrading, for example, a bond gets downgraded from, let's say, BBB to D, then of course the price would go down, okay? Now, the Basel Committee is measuring capital requirements in two ways. One, the standard approach. So the Basel Committee decides how much capital you need for each one of these categories, okay? Two, the Basel Committee, the regulator, allows you, bank, to use your own model. So there is the standard approach and there is the internal model approach. In the internal model approach, the bank can set the capital requirement based on its own internal model, okay? How does the standard approach work? Well, in the case of equity positions, very simply, specific risk is 8% of the gross general position, which is the sum of all long and short positions in equities and similar securities, and 4% when you have a liquid and well-diversified portfolio. And the generic risk, the systematic risk, is 8% of the net position, okay? So in the case of the specific risk, is the gross position. So you add up long and short. In the case of the generic risk, because you're looking only at the systematic risk, so the market risk, you take the net position, okay? So the difference between long and short. When we talk about debt positions, so fixed income, bonds, for example, the specific risk is computed looking at the maturity, the residual maturity of the bond and the rating, okay? And of course, as you can see, different risk weights depending on the residual life and the rating, okay? For generic risk for debt securities, remember we said the generic risk for debt securities is actually interest rate risk, okay? The generic risk for debt securities, the system is very similar to the one we saw for interest rate risk in the banking book, i.e. the bank has to basically include its interest rate positions, be it bonds, interest rate swap, interest rates futures, whatever, into a system of 15 different maturity buckets. which are a bit lower if the coupon is larger than 3%. The idea being that lower coupon means other things equal a higher duration. Okay. So as you can see, 15 different time buckets, maturity buckets, and then there is a coefficient which is increasing over time, which is a kind of proxy for modified duration for each maturity bucket, and an assumed change in yield, which is basically a proxy for interest rate volatility. So as you can see, the underlying logic of used by the Basel Committee to measure the generic risk for debt securities is very close to that of a parametric approach valued risk. Because basically you take the net position for each maturity bucket and you multiply it by a sensitivity coefficient, which is a proxy of the modified duration for that maturity bucket. You then multiply that by a change in yield, which is a proxy for volatility. And clearly we know that shorter interest rates are more volatile than longer ones. And therefore you see that this factor is decreasing over time. And by multiplying these three factors, you get the risk weight, okay? And then there is a complex system of, let's say, you can't actually compensate long and short position for each maturity bucket. As you can see, the different positions are included in 15 time bands, and those 15 time bands in turn are divided in 3 zones, different maturity zones. And there are, let's say, non-compensability factors for each zone, okay? Which is a bit complex, but I don't want to go into the details because it's not so relevant. The only thing I wanted to show you is that the standard approach for generic risk for debt securities very much resembles the underlying logic of a parametric valued risk, okay? Now, what about the currency risk, the foreign exchange risk? Well, the system adopted by the Basel Committee is the following. You have to take the capital requirement for currency risk is equal to 8% of the larger between the sum of the long positions and the sum of the short positions, okay? Now, what does that mean? Now, let's look at this simple example. Now, what you can see is, assume you have a long position in dollars of 30 million euros, okay, equivalent to 30 million euros. You have a short position in British pound for 50 million, equivalent in euros. You have a long position in Japanese yen, 25 million, and so on, okay? Now, the sum of the long positions is 60, okay? The sum in absolute value of the short position is actually 48, okay? So the long positions amount to 60 and the short position amount to 48. Now, assume you want to know what is your total position. Well, one way you could do is take long plus short and say, my total position in foreign currencies is 108. Clearly, this would be very conservative, very prudent, okay? And it would be equivalent to assuming that when you lose on the long positions, you also lose on the short positions, okay? Therefore, prudently, your total exposure is 108. So assuming that when you lose on one side, you lose on the other side as well, it's basically like assuming that there is a negative correlation on the evolution of the foreign exchange rate, i.e. that when your domestic currency, say euro, appreciates here, and therefore you lose on the foreign currencies, it also depreciates here so that you lose here too, okay? Alternatively, you could say take L minus S, which would be 12, okay? This clearly is the opposite. It's not prudent at all. It's basically assuming that when you lose here on the long positions, i.e. the euro appreciates, you gain on the other side, i.e. the euro appreciates with respect to these currencies as well. So this is assuming, perfect correlation, positive correlation among exchange rates for long and short, and this is assuming negative correlation, okay? Now, the approach which is followed by the Basel Committee is very simple, very simply a kind of average of these two. They say, okay, I want you to take the larger between long and short position, which would be, in our case, 60, okay? The long was 60. But if you think about it, if you take an average of these two approaches, a very conservative one and a very aggressive one, a simple arithmetic average would be 108 plus 12 divided by 2, which is equal to 60, okay? So this is kind of a midpoint between a very conservative and very aggressive one. And then what you have to do is take 8% of this, okay? That's the way the currency risk capital requirement is computed, and is still the case today, okay? Now, here we were in 1996. What were the main critiques of the banking community? Well, first of all, they said it's a building block approach, i.e. you sum all the capital requirements, i.e. you take the capital requirement for all these components and you add them up, and therefore you're not taking into account the benefit of diversification. The breakdown of risk is done by kind of instrument rather than by the underlying risk, and there is no recognition of the internal models. Now that's what happened in 1996. As I mentioned, the Basel Committee said, okay, I'm going to recognize your models. So not only you can measure market risk capital requirement following this approach, but you can use your own model, okay? However, if you use your own model, you have to respect a number of criteria. First of all, the confidence level must be at least 99%. Second, you have to estimate value at risk with a time horizon of at least 10 days, i.e. 2 weeks, 10 working days. So the holding period cannot be the daily one. It should be at least 2 weeks, okay? Third, you have to go back at least 1 year of data to estimate volatilities, correlations, whatever, historical simulations. You need at least 1 year of data. And finally, volatilities and correlations need to be updated quarterly, okay? However, the Basel Committee not only imposed quantitative criteria, but also qualitative conditions. First of all, you need to have an independent risk management unit. It cannot be, someone directly involved in trading. It needs to be an independent and separate unit, the one that is actually estimating all the parameters and computing then the capital requirements. Second, the value at risk model must be used in day-to-day risk management. I mean, you can't simply have a number of people doing number crunching and computing value at risk. You need to use them in day-to-day management, i.e. the applications we saw last time, i.e. risk limits, risk-adjusted performance, and so on, okay? I mean, if you don't use it, it means you don't trust it. So why should I, the regulator, trust it? Okay. Third, the board of directors must be highly involved. The board of directors must be involved in this process. Okay. It can't be something entirely delegated to quantitative people. The board of directors must be involved. Okay. And finally, the value at risk model must be integrated by stress testing. Remember, stress testing is not a value at risk approach. It's something that complements value at risk models. Okay. Now, if you respect all these conditions, how much capital do you need? Now, the minimum required capital, what you see here is minimum required capital, would be equal to the larger between the value at risk of t minus 1, so the value at risk of the previous day, and the average value at risk of the last 60 days. You see that that is the sum of the value at risk of the last 60 days divided by 60. So that's simply the average value at risk of the last 60 days, okay, times a multiplying factor. MF stands for multiplying factor. That multiplying factor is the penalty that I mentioned last week, when we discussed back testing. How does this work? Basically, the Basel Committee is saying, okay, first of all, you have to respect all these quantitative and qualitative criteria. Then, if you do so, the minimum required capital is given by this formula, this equation. But then there might be a penalty if your model is a bad model, okay? And the way it works is the following. The way the Basel Committee back tests, or if you want, evaluates whether your model is a good one or a bad one, it requires every bank to back test its model based on the last 250 trading days, i.e. based on the last year of data, and looking at the number of exceptions. If the number of exceptions, i.e. the number of days you lost more than value at risk, is equal or lower to 4, equal or lower than 4, then the multiplying factor is equal to 3. If it is higher than 4, it's more than 3, and that is the table that I showed you last time. I.e., if the number of exception is equal or lower than 4, then that multiplying factor is equal to 3. If it's above 4, then the multiplying factor is an increasing function of the number of exceptions. And if it's larger than 10, the multiplying factor is going to be 4. Now, why you would probably ask, why 3? Well, that is something that the Basel Committee did not explain. They simply said that there is the need of a multiplying factor because value at risk models are often based on assumptions which are a bit unrealistic, because value at risk models do not capture liquidity crisis for a number of reasons. But basically, the relevant function is this equation you see here. The capital requirement for market risks is equal to the larger between the value at risk of the previous day or the average value at risk of the last 60 days multiplied by a multiplying factor which is at least 3. So you can understand from this equation that unless you had a very significant shock in the last day, what is really relevant is the average of the last 60 days multiplied by a multiplying factor, okay? So that's the way the capital requirement for market risks are actually computed, starting from 1996, okay? Any questions so far? Is everything clear? Okay. Now, what happened afterwards? Now, we had two additional important steps. First of all, during the great financial crisis, we had quite a number of banks who recorded very significant losses in the trading book, okay? Now, these losses were actually often related to credit instruments. Think about, for example, asset-backed securities, collateralized debt obligations, and so on. These were securities traded in the market, but the main risk of which were very much credit risk, i.e. the credit risk of the underlying mortgages or loans, okay? And therefore, the regulators were very much concerned that they were actually imposing capital requirements on market risk, but they forgot to take into account that even if the banks were trading on these instruments, many of these instruments had a significant credit risk profile, okay? The third issue that came out was that quite a number of banks were arbitraging the system. So basically what they were doing, remember, banks were allowed to choose whether they wanted to use the standard approach or the internal model approach for market risk capital requirements, okay? And pay attention, if you opt for the internal model approach, it's not so easy. I mean, you need to apply, and then there would be a supervisory team coming to inspect your model, basically analyze the robustness, the quality of the data, and so on. And at the end, they could give you an authorization and therefore validate your model that then you could use for your capital requirement purposes, okay? Now, what was happening at that time is that there were significant regulatory arbitrage transactions, i.e. many banks were, with a validated internal model, were actually moving positions from the banking book to the trading book, okay? So say, for example, you have a number of securities and you simply shift them, move them from the banking book to the trading book, because in the trading book you would be subject to lower capital requirements, okay? So in some way these were kind of regulatory capital arbitrage. I move my positions in one portfolio to another, from one portfolio to another, to benefit from lower capital, okay? So how did the Basel Committee respond to that? And these were proposals that came out, as I said, after the great financial crisis, more precisely in 2012. First of all, there are two major innovations. One is the introduction of the so-called IRC. The IRC is the incremental risk capital charge. This was a measure aimed at addressing the second problem that we highlighted here, i.e. the losses related to credit risk. Basically, they introduced a capital requirement that was aimed at covering default and migration risk for unsecuritized credit products. So the idea was a number of securities that are in the trading book not only have market risks, but they also have credit risk, okay? And we saw that with, for example, mortgage-backed securities and things like that during the great financial crisis. So I want banks to have an additional requirement, which is called IRC, which is based not on a 10-day time horizon, but rather 1 year time horizon, okay? Second, they introduced a additional requirement, which is called stress value at risk. Basically, stress value at risk is requiring to apply to your current portfolio of today a measure of value at risk, which is estimated looking at a past period of significant stress, okay? And we'll see in a minute more details about that. And finally, this is less relevant. They eliminated the preferential treatment of 4% for specific risk of equities when you have liquid and well-diversified portfolios. I mean, it was all uniformed at 8%. Now, very quickly, IRC, now keep in mind, IRC is only applied for those banks that have an internal model validated, okay? And as I mentioned, it was aimed at facing the problem related to the fact that an increasing amount of the exposures in banks' trading books was actually related to credit risk and often illiquid products, okay? Clearly, if they are illiquid, the time horizon must be lengthened because it could be that you're not able to close your position in a short period of time. And therefore, you also have to take into account, let's say, price risk, price changes that come from credit factors, like, for example, credit migrations, i.e. downgrades, okay? Or significant moves of credit spreads, okay? And as I mentioned, this kind of risk were not adequately captured by the 99% confidence level value at risk measured with a 10-day time horizon. Indeed, IRC, you see that in the last line of this slide, is measured on a one-year basis, so with a one-year time horizon, and it has a 99.9 confidence level. So a very high confidence level. And it's an additional capital charge in the trading book, only for banks with an internal model approach, okay? Second, they introduced an additional capital requirement, which is called stress value at risk, as I mentioned, which is currently in place, and it's very relevant. Basically, if you look at the equation in the middle of the slide, you see that the first part of the equation is exactly what we saw here, okay? Basically, it says the capital requirement for market risk is equal to the larger between the value at risk of the previous day and a multiplying factor m times the average value at risk of the last 60 days, okay? This is exactly what we saw before, okay? Now, there is an additional component which is called stress value at risk. And it's exactly working in the same way, i.e. the larger between stress value at risk of the previous day or the stress value at risk of the last 60 days average times a multiplying factor, okay? Now, what is stress value at risk? Well, for example, assume that we are here today in March 2021. We measure value at risk looking at the past year of data, plus we should add a stress value at risk component, which is value at risk applied to my portfolio today based on a one-year period in the past. For example, I don't know, something that happened 2 years ago or 1 year ago of significant stress. So by definition, stress value at risk is equal or larger than the normal value at risk, okay? So you can see that these innovations, these changes, have significantly increased the capital requirement for market risk, very significantly increased, okay? Indeed, This is a table that is taken from a Basel impact study. BIS are Basel impact studies. Basically, the way the Basel Committee work is every time they make a new proposal, like for example, they did here, they proposed to introduce IRC and stress value trees. What they do, they then ask each individual large international bank to basically estimate the impact of these changes to their capital requirement, okay? So here, for example, you see the numbers in the table indicate how much in terms of the percentage of the existing capital requirement, the total capital requirement on market risk would increase as a consequence of, for example, stress value at risk. Stress value at risk more than doubled the capital requirement. The IRC similarly more than doubled, 102% increase. Okay. Together, all these innovations led to a basically an increase. If you had, for example, 100 of capital requirement for market risk in 2012, the new regime would bring your capital requirement for market risk to 323.7, i.e. a 223.7% increase. So a very significant increase, okay? Okay, this happened after the great financial crisis. What about more recently? More recently, there has been a fundamental review of the trading book, and also here there have been proposals for changes which are quite significant. First of all, remember, we still have a system where the capital requirements for market risk are either standard approach or internal model approach, okay? In the standard approach, I mean, I don't want to go into the detail, but it has been made more refined and more risk sensitive, so more precise. So, for example, not only delta risk, but also vega and gamma risk for options portfolios. Risk of changes in correlations have also been introduced. Second important point, the standard approach has become a floor to the internal model approach. So in some way, every bank, no bank can save capital by moving from the standard approach to the internal model approach. Plus, a kind of IRC has been introduced also in the standard approach. And in this case, is called default risk charge, i.e. it's a capital requirement, additional capital requirement for market risk in the standard approach that reflect the credit risk component of some instruments in the trading, okay? Now, the more significant innovation in the internal model approach is that the regulators are requiring banks to move from value at risk to expected shortfall. Okay, so this is a very significant change because basically over time, banks all over the world will have to move from value at risk to expected shortfall to estimate their capital requirements. Okay, and of course, just as expected shortfall will be substituting value at risk, we'll have a measure of stressed expected shortfall to substitute the stress value at risk. Okay. Also, the approvals process has become more rigorous. The risk of market illiquidity has been needs to be incorporated in the computation of expected shortfall. And there is the prohibition to switch instruments from the trading book to the banking book and vice versa. So once they've been classified, once positions have been classified, they need to remain there. Okay. Now, to give you an idea, all these changes have made the capital requirements, first of all, much more significant. And when people say, for example, with Basel III and so on, commercial banks are being penalized, And this is not really true. I mean, investment banks, who are the ones most active in trading, have been significantly penalized. And trading, proprietary trading by banks all over the world, has become less and less profitable. So very, very few banks have now proprietary desks, because the ability to generate profits consistent with the amount of capital you need, given the capital requirement regime, is very, very difficult. Okay, that's the first important point. Second important point, the internal model approach has become less and less convenient, meaning that there is no convenience for a bank nowadays really to adopt the internal model and use its own model to estimate value at risk, because most likely you will have a higher capital requirement than what you would get with the standard approach. And this in some ways is a bit of a pity, because allowing banks to use their own models was also a way to stimulate and favor best risk management practices in the banking industry all over the world. So in some way, this change is in some way something that cannot be seen as favorable. Okay. Any questions so far? Otherwise, we take a look at a few questions. Okay, question 1. Which of the following quantitative requirements is not necessary for a bank's internal model of market risk to get its own model validated by the Basel Committee for capital computation purposes? Okay, I give you 1 minute and you tell me what is the correct answer. Come on, what's the correct answer? C, that's correct. Measurement of value at risk at least once a fortnight, that's not true. It must be daily. A French bank has the following FX positions. Based on the data above, compute the bank's foreign currency related capital requirement under the market risk standard. As you can see, you have US dollar, you have a net position which is long by 65. Japanese yen, the position is short by 5. British pound, the net position is short by 15. Swiss franc, the net position is long by 18. No, sorry, by 23. And finally, Australian dollars, the net position is long by 7. So these are the data, US dollar, yen, pound, Swiss franc, Australian dollar. So the sum of the long position would be 65 plus 30, so 95. And the sum of the short position is 20 in absolute value. So the max of the two is equal to 95. Therefore, the capital requirement would be 8% times 95. Okay. Finally, which of the following criteria is used by the Basel Committee to measure the quality of an internal market risk measurement model? You give you a minute and then you tell me what is the correct answer. Come on. What's the correct answer? No one wants to try? C, exactly. C is the correct answer. Comparing the frequency of the losses exceeding value at risk with the ones implied in the model's confidence level. Okay? Okay, this is it for what it concerns market risk on capital requirements. Now, what I want to do now is, first of all, as I mentioned, I uploaded on Blackboard a simple mock exam midterm, and I mentioned to you what is the structure of the midterm exam, which, as I mentioned, is going to be only concerning interest rate risk and liquidity risk. Now, as you can see, the exam has two parts. One is two open questions, and pay attention. One is very descriptive. For example, here it was making reference to interest rate risk, explain what is the problem of the duration gap model addressed by the clamping model. Well, the fact that the duration gap model does not take into account the possibility of different changes of interest rate of different maturities, and explain why that problem is not adequately addressed by the beta duration gap. I mean, it's not addressed because the beta duration gap is not taking into account the possibility of different changes of interest rate of different maturities, but rather the different changes of interest rates of different assets and liabilities. And what criteria should guide the choice of the nodes? Remember, the criteria were same market value. The choice of the nodes, remember, is more frequent nodes in the short-term part of the yield curve, because first of all, we have hedging tools available, and second, because the volatility of interest rates is higher for short-term rates than from long-term rates. So this is very descriptive question, okay? To understand whether you attended the course, you studied the material, and so on. The second one is more reasoning. So critically discuss, stating if true or false, the following argument. This bank is considering the possibility to buy a one-year treasury bill, funding it with the issue of an equivalent amount of a one-year certificate of deposit. While this would have no impact on the bank one-year maturity adjusted gap, it would have an impact on the bank's duration gap. Now, you have, first of all, you always have to state clearly whether it's true or false, okay? And in this particular case, the statement is true, because indeed the maturity adjusted gap would not be impacted because the asset and the liability have the same maturity. But it is true that the duration gap would be impacted, because if you increase assets and liability by the same amount and keep the equity constant, leverage would change. And therefore, the duration gap, which also has leverage, would be affected. And this is the answer. The argument is true. Indeed, the maturity adjusted gap would not be affected. Their maturity is therefore. On the contrary, the duration gap would be affected. Indeed, both assets and liability would increase for the same amount, with an asset and liability with the same duration. However, the effect of the leverage on liabilities would lead to a change in the duration. Okay? So to recap, one question is very descriptive, the second one is more reasoning. Okay? Let's see, there is a question. Is it correct to say that it does not have an impact on duration gap with liabilities and assets? Yes, I mean, of course, it's very unrealistic, because the question is, if assets and liabilities are exactly the same in terms of amount, it means that we are considering a bank with zero equity. Would it be correct to say that it would have no impact on the duration gap? Well, in this case, yes, because basically the leverage would be 1 and it would remain 1. But clearly it is quite an unreasonable case. And if you only say that, that would not be enough. Then you have a number of multiple choice questions. And I want to ask for your forgiveness, because the first one is incorrect. Because the first one says the one-year repricing gap of Bank Alpha, whose assets and liabilities are made up only of fixed rate items is equal to 100 million, while its 1 year maturity adjusted gap is equal to 50 million. This means that, and the correct answer was identified as bank alpha sensitive assets had a higher average maturity than the one of its sensitive liabilities. Well, that's not necessarily true. There might be a case where actually the average maturity of the assets is the same, for example, of the one of sensitive liabilities, and the statement, the original statement, would still be true. So that is not the correct answer. The point is that in this question there is no correct answer, because the correct answer is that it cannot be known in advance. Okay, we don't have enough elements to know. The other questions are correct, and you have the solutions at the end. Okay, and as you can see, these are all questions that similar, or the ones that we saw in class. We saw at every session quite a number of multiple choice questions, and those are the kind of questions that you get in the midterm exam. As I mentioned, very important, the midterm exam will have a 25% weight on the total final grade. 25% will be given to the assignment, and 50% will be given to the second part of the exam. Or if you only do the final exam and do not take the midterm, it would be 25% the assignment, 75% the final exam. You will have 30 minutes for the midterm exam, and the open questions, the two open questions are each going to be worth 6 points, while the multiple choice questions will be worth 3 points. The correct answer will be worth 3 points. The other alternatives could be worth 0. They could be worth 1 if it is not completely incorrect. But if it's completely incorrect, could also be worth -1 when we believe that the answer is completely incorrect. Okay, so there could even be a negative point for wrong answers, which is a clear incentive not to give random answers if you do not know what is the correct answer. Okay, so that's the structure of the midterm exam. And as I mentioned, it will not be addressing the market risk section of our course, which will be the subject of the assignment. Okay, any question on what I said till now? Okay, in this case, let me just say just a couple of words, because we have a few minutes left, on what we're going to do next, okay, on the next section of the course, which is going to be related to credit risk. So basically, when we meet, not next week, but the following one, we'll start talking about credit risk, okay? Now, what are we going to do with credit risk? Now, basically, we'll look at two major components. As you know, the expected loss of a credit exposure, be it a bond, a loan, whatever, is given by two important factors: the probability of default and the loss given default. There is a third one, which is the exposure at default, that we'll only touch marginally. We'll not spend much time about that, okay? We'll mostly focus our attention on PD and LGD. When we address the PD, we'll look at two main types of models. First of all, we'll be discussing scoring models. Now, scoring models such as discriminant analysis or logit and probit model. Okay. This is a particular technique, discriminant analysis, that, as the name says, tries to discriminate between good and bad borrowers. Okay, looking at past data, you take a sample of past borrowers, some of which defaulted, others not. Okay, and logit and probit model are more, let's say, based on a more familiar technique because they are basically regression kind of models. Okay. And these models are mostly based on accounting data, okay? So balance sheet data, and I would say also behavioral data, i.e. How borrowers behave with respect to loans, okay? And for example, a very famous discriminant analysis model is a Z-score introduced by Ed Altman that you may have heard about. Okay. So first family of models we'll focus our attention on is scoring model. Okay. Second, we will look at capital market models, i.e., models that basically look at capital market data, okay? And here we have, again, different type of models. For example, models that are both based on bond spreads, okay? I.e., you estimate through bond spreads, through the spread of a bond, risky bond issued by a corporate, what is the implied probability of default of that corporate, okay? Or we could use, rather than bond data, rather than fixed income data, equity market data, okay? And basically here what we look at is equity values and equity volatility. And we'll see that by combining these data, using a Merton kind of model, so the model originally developed by Robert Merton, and he won the Nobel Prize for that, which is a kind of structural model, i.e. it looks at the structural feature of a company. Structural features means basically financial risk and business risk of a company. Okay. So we'll see how we can use this kind of data through these kind of models to estimate the company probability of default. Okay. Then we'll move to the second component, which is LGD. Okay. And when looking at LGD, we'll try to understand how we can estimate the LGD, or if you want, as you know, LGD is 1 minus the recovery rate, okay? I.e., how much do I lose, or if you want, how much I can recover when there is a default, okay? And here, clearly, we have an additional problem because defaults are not so frequent, so we don't have so much data, okay? But again, we'll try to look at different approaches like the one based on market data. And when we talk about market data, we mean basically post-default prices, okay? I.e., what happens to the price of the bond after there is a default, okay? And alternatively, the recovery rate from defaults, okay? So basically what you do is you compute, in this case, the present value of future recoveries, okay? And so these are the two main parameters we're going to look at: probability of default and loss given default. This is, of course, relevant for estimating the expected loss of a credit exposure. But what about the unexpected loss component? And let me give you an idea of what I mean by that. Assume this is the probability distribution of credit losses, okay? So if you want, you have the loss rate as a percentage of your portfolio here, and here is the probability. So in some way, this can be seen as the expected loss, the mean value. But say that this is, for example, 1%, but you know that, so on average, that is what you expect on your portfolio. But you know that if things go wrong, for example, you can end up at 5%. And say, for example, that this tail above here has a probability of 1%. Okay? So if this is the case, how much is value at risk? So the expected loss is 1%. But if things go wrong, go up to 5% loss rate, and the probability of losing more than that is only 1%. So how much would be value at risk 99%? Who tells me? How much is value at risk? 99% confidence. Come on, it's very easy. At least one of you. Well, basically, it would be the difference between this amount, how much worse it can go, and the expected loss. This 4% would be value at risk, okay? And how do we estimate the unexpected loss component? Well, this can be done using credit portfolio models. And that's what we're going to do afterwards. And we'll more specifically look at two models, which are very much used out there in the market. One is credit metrics, and the other one is credit risk plus. This was introduced originally by JP Morgan. This was introduced originally by Credit Suisse First Post. Okay. So that's what we're going to look at in the second part of the course when we talk about credit risk. And clearly, once we've done that, we'll look at capital requirements for credit risk, okay? And just as we did with interest rate risk and market risk. Once we've done all the models and how we can measure that, we look at the capital requirements, okay? Any questions so far? Okay, so I'll see you for, well, I don't think we're going to see you for the exam. We're going to see you the following week, okay? You have a nice day. Bye-bye.